My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Investing isn't easy, but it can be a lot easier if you find someone who's willing to walk you through all the arcane terminology and authentic Wall Street gibberish that makes the whole process seem really impenetrable. There's an entire industry of people who earn their living by doing the opposite of that. They want you convinced that investing is too hard, that regular people just can't do it, that the safest thing is to give your money to a professional or stick it in an index fund. The truth is, that's the right call for many of you. And everyone should have some index fund exposure. But if you put in the effort, if you do the homework, then I believe you can manage some of that money, as well as the pros. The truth is, many of those professionals really, let's just say they're focused on getting your fees. They're more interested in taking your money than making your money. And that's a lot easier if they can keep you ignorant about the market. They're kind of like the Wizard of Oz. They don't want you peeking at the man behind the curtain. They don't want you to understand, because if you did, then maybe you'd take control of your own finances, pick your own stocks, and not pay someone else potentially exorbitant fees to do the things you're perfectly capable of doing yourself. And that's where I come in. I'm pulling back the curtain and explaining everything, because while authentic Wall Street gibberish can sound complex, it's not rocket science or brain surgery. You don't need to go to business school or work in an investment bank to understand it. You can comprehend all the abstruse vocabulary that we throw around as long as you have a translator, a coach like me who can explain what it all means. Think of me as a defector, someone who played for the other team, managing about $500 million of already rich people's money at that old hedge fund of mine, but who's now playing for you, teaching you how to navigate your way through the minefield of the stock market every weeknight here on Mad Money. All right, forget the Da Vinci Code. Forget Enigma. To be a grand investor, you need to break the Wall Street code, and I'm here to help you crack it. That's why tonight I'm giving you my Wall Street gibberish to plain English dictionary. Consider it a glossary of the most important terms that you absolutely must understand if you're going to actively manage some of your own portfolio. Words and concepts that many people in the financial industry really don't want you to get your head around, because then you might actually feel more empowered enough to pull your money out of their mutual funds or ETFs or stop handing over your fees. Let's start with a couple of extremely important ideas that we talk about all the time. They go hand in hand. Cyclical and secular. Now, you hear these all the time, right? Yet no one ever seems to explain what they mean, even though they're crucial to the process of picking good stocks. Cyclical has nothing to do with the spin cycle or your washing machine or Wagner's ring cycle, not my kind of classical music. And secular isn't about the separation of church and state. Oh, and yes, a kudo to the late Louis Rukeyser, who first cracked that cyclical joke. We say a company is cyclical if it needs a strong economy in order to grow. It's cyclical because it depends on the business cycle. So machinery companies like a Caterpillar and Eaton fall into this category, along with raw materials players like a BHP or a Rio Tinto and commodity chemical companies like the new Dow Chemical or PPG. These cyclical players are indeed hostages to the vicissitudes of the economy. When the economy heats up, they earn more money, and we're willing to pay more for those earnings. But when it slows down, they earn less money, and investors pay less for their shares. And that's why they want to sell them ahead of time. A secular growth company, on the other hand, is one where the earnings keep coming regardless of the economy's overall health. Think anything you eat, drink, smoke, brush your teeth with uses medication. So you've got consumer staples like a Procter & Gamble or a Colgate, food, General Mills, Kellogg come to mind. Drug stocks, I think you're Pfizer, a Merck, a Bristol Myers. These are the classic recession-proof names that tend to outperform whenever the economy hits a rough patch, and Wall Street suddenly develops a craving for safe, consistent earnings. You don't stop eating or brushing your teeth just because of a recession, or at least I hope you don't. What makes the secular versus cyclical distinction so important to you? Why is it the first piece of Wall Street jargon that I'm translating tonight? Because it helps you figure out how much money companies will earn. And because it matters to the big institutional money managers, the guys who have so much money to throw around that their buying and selling actually controls the day-to-day action in the market. They decide whether stocks go up or down. The whole hedge fund playbook is about when to buy and sell cyclical stocks or secular ones based on how the global economy is holding up. And this is what drives their decision-making process. Remember, historically, about 50% of the performance of an individual stock comes from its sector, which is just a fancy word for the segment of the economy a stock falls into, like a tech, energy, machinery, healthcare, finance. And when it comes to sectors, much of those moves are driven by whether they fall into the secular growth or secular growth camps. And the cyclical growth camps, by the way, are the ones, again, up and down. Secular is this. You've got to know these things. You don't want to own much in the way of cyclicals when the economy seems to be slowing. Those stocks are likely to get crushed because the numbers come down in a recession. You can try to make yourself less cyclical. In recent years, for instance, the railroads have become much better operators, so their earnings don't get hit as hard, even with big revenue shortfalls. But in a real recession, well, you don't want to own their stocks. By the same token, when business heats up and the cyclicals are doing well, nobody wants to own a boring, consistent recession-proof secular grower. And you won't make much money in them during those periods either. That's the logic behind another needlessly opaque piece of investing terminology. It's called the rotation, which is when money flows out of one of these groups and into the other. Now, this idea is totally antithetical to the brain-dead philosophy of buy and hold that I spend so much time trying to debunk. A zombie ideology that refuses to die, even though it's been utterly discredited by the market's performance. You don't want to hold cyclical stocks going into a genuine recession. That's a recipe for disaster. It's always been a recipe for disaster. There's nothing new there. Once you recognize how powerful the secular versus cyclical distinction is, well, then you can see why buy and hold can be just outright silly. If you're planning to own stocks through thick and thin, no matter what, then you need to be prepared to lose money in the cyclicals when they're out of favor, or tread water in the secular stocks, or even have them go down a shade when the cyclicals are roaring. Why take that pain when you can avoid it? Of course, that doesn't mean you should try to game every single rotation. That's too hard. It shouldn't mean you should concentrate all of your capital in the cyclicals or the secular growth names, depending on what's in stock. No, not at all. You always need to stay diversified. Another important piece of investing vocabulary. It simply means, well, making sure you don't put all of your eggs into one sector basket. You're diversified when you have no more than 20% of your portfolio in any single sector. That way you won't get annihilated if, for example, a rotation takes down all the cyclical stocks because you still have some secular growth names that are holding up much better, or even making you money at the same time. Bottom line, investing isn't easy, but it doesn't have to be mystifying or intimidating. You just need to learn the lingo. Know the difference between cyclical and secular growth stocks. Recognize the sector rotation when you see one, and always stay diversified. Frank in Arizona. Frank.
Jim, I bought a large block of stock in a blue chip company that pays a safe 5% dividend and historically trades in a very narrow range. I bought that stock in 4 equal block increments, and each purchase I was able to buy at a lower price, always bringing down my average cost. Being somewhat Cramerized, I know that it's wise to reinvest the dividends. The stock has risen $3 above my average cost. If I reinvest the dividends now, it will bump up my average cost, and I don't want to do that. Should I take the dividends in cash?
No, in this one particular case, I am not. I am going to look the other way about raising your basis, because I just think that the power of compounding is so fabulous. It transcends even the idea of raising your basis with a buy. Let's go to Sally in Michigan. Sally.
Hi there. Hi, Jim.
Sally.
I'm hoping that you can help me understand the difference between chasing a stock or just buying a few shares at a time when it's going up or going down.
Okay, look, chasing a stock, we see a stock, say, up 3%, 5%, 7%, 5%. Well, you're clearly chasing it. I like to be able to buy a little bit and then wait till it comes down. And then the worst thing that happens is it runs away, and then you can ring the register. It's really that simple. I try to keep it simple. Lee in Virginia. Lee.
Booyah, Jim. I've heard you talk about the S&P oscillator
Certainly.
as a reliable indicator of overbought or oversold market conditions.
Right.
Since this tool is specifically an S&P 500 indicator, I'm wondering if there's a similar tool for the NASDAQ 100. More importantly, how reliable is it for predicting if an individual stock is overbought or oversold? And what indicators are there that an individual stock might buck the trend and continue to go higher when the market is overbought, or keep going lower?
Okay, ever since the mid-'80s, I've been paying the S&P company a fee in order to be able to get both their oscillator, which shows you whether there's too much buying pressure, too much selling pressure, and individual stock charts, which are now sent electronically. They are S&P because it's the S&P company, and that's all I use it for. I want to be very careful here. I get it. I pay for it. I can't give it out. That wouldn't be right to the S&P company. But I find it invaluable because when the S&P oscillator goes above 5, it makes me feel like that things have gotten too, let's say, bullish. And when it goes below 5, things have gotten too bearish, and it may be time to take some action, obviously, counter to those trends. John in Maryland. John.
Hi, Jim. Great to talk to you, and always a big fan.
Oh, thank you very much.
I wanted to ask a question about my 401k allocation mix.
Certainly.
We hear so much about dialing down risk, success rates of portfolio mix in retirement, and the smoke and mirrors about historical returns should be used as a proxy for future returns.
Right.
So I'm thoroughly confused, Jim. I'm about 3 to 5 years out from retirement and historically have invested in equities at the 70 to 90% level for over 25 years. But this year I dialed it down to 55% equities and 45% treasuries. How would you structure a portfolio now and in retirement?
Okay.
Also, should I consider rolling these monies over to have more choices in retirement, as I have limited opportunities in my employer?
I want you to have as many choices. I think that retirement is almost a false dichotomy. I think that the issue here is long life and life expectancy. And you may retire, but you need to have your money continue to work for you. I like your breakdown. That's one I would share. But we all have to have our own views, optimistic or pessimistic, or so let's say constructive or a little less, more cautious, and then tailor your suitability. In other words, don't be rolling the dice if you think you're going to need the money within the next couple of years. All right, I know Wall Street gibberish can be very hard to maneuver. I'm here to make it possible for you to do so. Oh, man, tonight, feel like the ticker is speaking in tongues? I'm helping you translate the terminology starting with the P/E ratio. Then the vocabulary lesson doesn't end there. I'm telling you what defines the short-term stock picking you see in this market, and a deceptively simple term that you may not understand. I'll reveal it just ahead, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.